Talk to us about where you are in terms of expectations for the Fed right now. You've been pretty hawkish in the past. You expect Jay Powell to be hawkish tonight. What do you think is going to happen?
It's pretty remarkable. I mean, think back just a second to reflect. It was exactly this meeting, exactly 2 years ago, March of 2020, when Powell brought down rates 100 basis points and embarked on a QE easing program that led to $5 trillion of printing of money. And so here today we are with inflation raging out of control at 8%. We've never seen ever in the history of this world rates at zero with inflation raging like this, having gone from sub 2 to 8%. So the Fed is so far behind the curve. I think what he says in his language is going to be to calm markets, but what he has to do is control inflation. And so every meeting this calendar year, he's going to have to raise rates.
Well, Bruce, if the Fed is as behind the curve as you say, will 25 basis point hikes do the job?
But he's already showed his hand. He's already told you at his last correspondence that, which is, I don't think you're supposed to, show that hand then, but he did. He said 25 basis points. So that's in the market. That's what we all expect. That's what it will be. But what's more important than that is kind of what comes next, which is a tightening at every Fed meeting over the course of the next year. And in one calendar year, you have 8 meetings. And so there's 7 left this year. So every meeting this year and into next year, a tightening expected to get Fed funds where it should be, which is 2 to 2.5%. And mixed in there, you'll see a couple 50 basis point increases. And, I mean, you know how bad inflation is when even Tom Brady comes out of retirement, right? So
don't get me started on that, Bruce.
But it's not only Tom, it's like every household's feeling this. It's food, fuel, housing, all goods, all services. Every company on every company call we talk to, is talking about inflation and talking about their cost of inputs, cost of manufacturing, cost of labor. And so it's spilling through. And what I say also, Guy, Kailey, is that when you have the first, second, third, and fourth, it's not going to be problematic for the markets. When you have that 5th, 6th, and 7th, that's when the financial conditions tighten enough, and that's when the pain's going to be felt in the marketplace. So when I think about markets, I look at the equity markets, where they are now, properly priced at, say, an 18 multiple. I think for the high for the year won't get you back to where you started the year at 4,800. I think it'll probably get you around 45 or 4,600. You're supposed to sell into that. I think at some point this year, later this year, as conditions really tighten, you can look at wiping out all of 2021 gains, which is getting the S&P back down to 3,800. As it relates to credit, it's the worst start for credit and the worst start for fixed income that we've seen ever, with high yield down 6% thus far, IG down 9%, emerging markets down 12%. And there's also really good opportunity with the coupons that they provide to be able to buy credit at very, very cheap valuations.
Bruce, when we talk to the asset managers, when we talk about the idea that you should still be fully invested, they say absolutely 100%. You need to be fully invested in this market. When you ask them about cash and how big a part of your portfolio should be cash right now, they pull a face because they say that you should not be in cash. What do you think cash does to a portfolio right now? Do you want to be in cash? How much cash do you have? What are you thinking about when it comes to cash?
Well, in the public markets, in the credit markets, our book is yielding in the liquid markets, 5, 6, 7%. And you take a look at emerging markets, when you take Russia out of emerging markets, which comes out of all the indices at this month end, you're talking about being down 12% on the year with a 7% type coupon. And so we think when that market recovers, it could be up 15, 20% total rate of return. That's the liquid markets. In the private credit markets, because we provide a lot in the private credit markets in the form of, lending and the form of capital solutions. And I think buyouts is going to be a big year because equities are down and the leveraged loan market, floating rate assets, people like. And so we're able to provide all kinds of financing to the buyouts. And so I think it's going to be a big year for buyouts in private equity because of attractive multiples and how open the leveraged loan market is. And so our capital solutions business, our asset-based lending business is a double-digit type return with very low volatility. And so I wouldn't be in any cash. I'd be taking, any cash I have and finding private investments both in private equity and in private credit, and deploying cash that way. As it relates to the liquid markets, look, you have to be able to trade. I think this is a trader's market. And so I think there's times to be in cash. And when the equity markets go up, and you're talking about 4,600 S&P, you're supposed to let go of a portion of your equities because you'll be able to buy them back 15% lower before this whole Fed tightening cycle is over. So I think it's a trader's market, a lot of volatility. Cash isn't going to earn you anything. It's going to get eaten by inflation. And there's a lot of very smart things to do.
All right, Bruce, so if you don't want to be in cash, another place where it hasn't been fun to be for the last couple of weeks is anything that touches Russia. What can you tell us about your Russian exposure?
Well, Russia exposure here at Marathon, look, we manage some index products. It's part of the index. It's coming out of the index. X that we have no Russia exposure. And so we're very proud of the fact that we were defensive as it relates to Russia. And, listen, Zelensky is the person of the year. And I think, teaches all the world leaders what it is to be brave and to have vision. And so watching him address Congress this morning to a standing ovation was amazing. But this is Putin's war, and Putin has turned Russia into a very difficult place to invest. Some characterize that as a pariah country, and we don't want to have any capital deployed in Russia. So there's other places for us to go. What I'd say is, you just look at what happened yesterday with the nationalization of all the airlines. And so there's 523 planes that the West, U.S. and European investors have unleashed with Russian airlines, and all those planes have been seized, all 523 of them. And then on top of that, Putin yesterday signed a decree to nationalize the Russian airlines. So which other industries is it also going to nationalize? Marathon has a nice size aircraft leasing business, and we don't have a single plane in Russia, not a single plane on lease to any Russian companies. And so I'd be very cautious with Russia. I don't think the West should be deploying capital there. And I think the defaults, and we talked about this earlier today in our call, with Euroclear and the freezing of and sanctions and regulations and the freezing of their capital, the Russian sovereign overseas, the default's going to be rolling in one after another after another. It'll take a few weeks yet, but sometime in the second half of the second quarter, so you're talking about May and June, you'll see default after default after default hit, as the West has characterized Russia as a pariah country.
Bruce, let's turn our attention to China. Chinese stocks are coming roaring back today after being battered for quite some time, but nevertheless, a massive rally as the Chinese authorities seem to get in behind the Chinese asset markets and say that they have their back. What do you think about the Chinese economy? Are you allocating cash there? What do you think of it right now? And do you think a rally like we're seeing today has legs? So, yes, I think the rally has legs, but and I'll tell you why in just a second. So Chinese economy, asked about that, growing at 5%. The Chinese government is lowering rates, not raising rates. So they got ahead of that curve, and they're making those adjustments. And He, who's the vice premier to President Xi, came out and made some very bold statements today, and it's going to help, Chinese tech, Chinese economy. But he talked about the easing of regulation. He talked about we'll have to see what follows up with that, but the easing of regulation and the support that the Chinese government is now going to provide both markets as well as the economy. And he's very clear, Vice Premier He, who is the second in control in charge of all economic policy in China, was very clear to say not only the economy and housing, but markets. And so with that, ADRs have ripped it. I wouldn't want to be those folks that capitulated yesterday and the day before, selling their ADRs, selling their Chinese holdings in the hole, because I think we're in recovery mode. They came in very, very cheap on a valuation basis. And what you were worried about is geopolitical risk. And you were also worried about, taking regulations which would further prohibit these companies from prospering. And they've come out and made some very bold statements they hadn't made in the past. So I think those folks that sold will definitely regret that. I think this move that we're seeing this morning will have legs, but this is the initial jump of that. It may retrace some of that, but over time, I think it will improve as the Chinese government realizes that they don't want to destroy their private companies.